On November 12, 2025, the world of cryptocurrency was rocked by a development that few saw coming. As the day began, traders and investors were glued to their screens, watching for any sign of volatility. But what unfolded was more dramatic than most had anticipated. Bitcoin, the flagship digital currency, shocked the market by plunging below the $103,000 mark, a level that had previously served as a strong psychological barrier for both bulls and bears. The sudden drop sent ripples through the entire financial sector, with headlines flashing across news outlets worldwide. The drop, 1.8% overnight, caught investors off guard and continued a streak of recent losses, shaking confidence in the crypto king. For many, this was more than just another dip. It was a wake-up call that the relentless upward momentum of the past months might be faltering. Traders scrambled to make sense of the sudden reversal, with some rushing to cut their losses, while others saw a potential buying opportunity. This wasn't just a blip. It signaled that bullish momentum is facing real headwinds. The mood shifted from optimism to caution almost instantly, as analysts began to question whether the market had become overheated. The storm clouds gathering over the Bitcoin bull statue seemed to reflect the uncertainty gripping the market. The fall below this psychological level triggered panic selling and forced everyone to reassess the market's strength. Trading floors buzzed with activity as sell orders flooded in, and social media lit up with speculation about what might come next. For some, the fear of further losses outweighed the hope of a quick rebound. Is this a healthy correction, or the start of a deeper downturn? Investors and analysts debated fiercely, weighing the possibility that this could be a much-needed reset after months of relentless gains, or the first sign of a more prolonged bear market. The uncertainty left many on edge, unsure of whether to hold, sell, or buy the dip. The answer lies in a web of economic, political, and industry-specific factors. From shifting government policies to global economic pressures, every piece of news seemed to add another layer of complexity to the unfolding story. The interconnectedness of global markets meant that Bitcoin's tumble was felt far beyond the world of crypto. In this analysis, we'll break down the key forces behind Bitcoin's slide, from US government moves to new digital currencies and global tensions. We'll explore how regulatory changes, international conflicts, and the rise of competing cryptocurrencies are all playing a role in shaping the current landscape. Let's piece together what's really driving the crypto market's latest shakeup and see what the future might hold for Bitcoin and the broader digital asset space. After weeks of uncertainty and political gridlock, the US government finally ended its record-breaking shutdown, a moment that many on Wall Street had been anxiously awaiting. The reopening was seen as a major relief for the broader economy, restoring confidence that essential services and federal workers would return to normal operations. Historically, such positive government moves have triggered strong rallies across financial markets, as investors breathe a collective sigh of relief and rush back into riskier assets. True to form, stocks surged on the news, with major indices climbing as traders celebrated the end of the shutdown and anticipated a return to business as usual. But in a surprising twist, the world of crypto didn't join the party. Instead of rallying, Bitcoin and its peers actually dropped further, defying expectations that they would follow the stock market's lead. This growing disconnect highlights a new reality. Crypto is no longer simply mirroring the moves of traditional markets. The days when digital assets would automatically rise or fall in sync with stocks seem to be fading. Investors, wary of ongoing volatility and regulatory uncertainty in the crypto space, are now more selective than ever, steering their capital towards safer, more familiar assets like stocks and bonds. Meanwhile, cryptocurrencies are being left out in the cold, struggling to attract the same level of enthusiasm or trust. The reopening of the government was widely expected to boost risk appetite across the board, encouraging investors to take chances on assets like crypto. Yet, the optimism that lifted stocks never reached digital assets. Instead, crypto prices remained flat or even declined, leaving many investors puzzled and disappointed. Increasingly, the crypto market is being shaped by its own internal challenges, ranging from regulatory crackdowns and security concerns to debates over technology upgrades and adoption rates, rather than by the broader economic headlines that move traditional markets. These days, even strong macroeconomic news isn't enough to spark a crypto bull run. The digital asset world is charting its own course, often at odds with the rest of the financial system. For crypto investors, the government reopening was little more than background noise, overshadowed by bigger concerns and the unique challenges facing the digital asset space. Bitcoin stumble dragged the entire crypto market down with it. Ether fell nearly 3%, XRP dropped over 3%, and Solana lost almost 6%. No major coin was spared. Even meme coins like the Trump token took a beating, dropping nearly 9%. The uniform losses point to a classic risk-off event. Investors are pulling out of crypto across the board, not just rotating between coins. This sea of red highlights how tightly the market's fate is tied to Bitcoin's performance. When confidence in Bitcoin wavers, the whole ecosystem suffers. Diversification within crypto offers little protection in these moments. For now, when Bitcoin sneezes, the rest of the market catches a cold. While crypto sank, stocks rallied on the back of the government reopening. Investors, relieved by reduced political risk, shifted capital into equities, favoring stability over the volatility of digital assets. The logic is simple. A functioning government boosts business confidence and earnings, making stocks the obvious play. Crypto, less connected to government operations, didn't benefit from this optimism. Today's events challenge the idea of Bitcoin as a safe haven. Instead, it was treated like any other risky tech investment. The pivot to stocks shows investors are making smarter, more targeted moves. Crypto can't rely on riding the coattails of broader market rallies. It must now stand on its own narrative to attract capital. Doubts are rising about companies holding massive Bitcoin reserves. Once seen as bullish, these corporate treasuries now worry investors. If these firms face trouble, they could dump their Bitcoin, crashing prices. The risk is real. Many operate in volatile sectors, and a financial hiccup could force a sudden sell-off. Lack of transparency adds to the anxiety, as investors fear large sales could happen without warning. The market is demanding more clarity and better risk management from these companies. This scrutiny marks a maturing market. Investors want more than just headlines. The days of blind trust are over. Accountability and transparency are now essential. While this skepticism adds pressure, it's a healthy step toward long-term stability. Amid the chaos and rapid evolution of the financial world, JP Morgan made a bold move by launching its own digital token, JPM Coin, specifically tailored for its institutional clients. This wasn't just another cryptocurrency entering the market. It was a statement from one of the world's largest banks, signaling that the era of digital finance was no longer just a Silicon Valley experiment, but a reality embraced by Wall Street's biggest players. Unlike decentralized cryptocurrencies such as Bitcoin, JPM Coin is a deposit token, fully backed and pegged to the US dollar. Its primary purpose is to enable fast, secure, and efficient transactions between institutional clients, allowing them to move money in real time across borders and business units. This innovation aims to eliminate the delays and inefficiencies of traditional wire transfers, making large-scale financial operations smoother than ever before. What sets JPM Coin apart is its foundation. It operates on Base, a blockchain network closely linked to Coinbase, one of the most prominent names in the crypto industry. This partnership is a clear signal that Wall Street is not just observing blockchain technology from the sidelines, it's actively integrating it into its core operations, bridging the gap between traditional finance and the digital asset ecosystem. The introduction of JPM Coin is a double-edged sword. On one hand, it brings a new level of legitimacy to blockchain technology, showing that even the most established financial institutions see value in this innovation. On the other hand, it introduces a powerful, regulated competitor to existing cryptocurrencies, potentially shifting the balance of power in the digital asset space. For some in the crypto community, JPM Coin is seen as a threat. They question the need for volatile, unregulated assets when a stable, bank-backed token is available, backed by the full faith and resources of a financial giant. This could draw institutional money away from traditional cryptocurrencies, impacting their adoption and value. Yet others see JPM Coin's arrival as a long-term positive. By paving the way for broader adoption of digital assets, it could help normalize blockchain technology in mainstream finance, encouraging more banks and businesses to explore and invest in this space. For now, however, the market's attention is fixed on the competitive threat posed by JPM Coin. This uncertainty has amplified bearish sentiment, with traders and investors closely watching how the landscape will shift as traditional banks step further into the crypto arena. Ultimately, the debut of JPM Coin serves as a powerful reminder. The boundaries between traditional finance and the world of crypto are dissolving at a rapid pace, and the future of money is being rewritten before our eyes. As if the market needed more drama, China accused the US government of orchestrating a massive Bitcoin theft, worth $13 billion. The allegation centers on a 2020 hack of the Lubian mining pool, with China claiming it was a state-level operation led by the US. This isn't just cybercrime, it's international espionage, raising the stakes for crypto security. The timing is suspicious, coming amid heightened US-China tensions. Whether true or not, the accusation injects fear and uncertainty into the market. It challenges the core belief in Bitcoin's security and decentralization. Investors now have to consider sovereign risk. Could governments target their assets? This geopolitical twist is rattling nerves and fueling the current price drop. Digging deeper, China's report paints the Lubian hack as a sophisticated state-sponsored operation. If the US government was involved, it would be one of the largest digital heists ever. This narrative introduces a new risk: state actors targeting crypto, not just criminals. The US has yet to respond, leaving a vacuum for rumors and speculation. Investors are left questioning the security of their holdings and the motives behind China's timing. The incident spotlights vulnerabilities in the crypto infrastructure. Exchanges, wallets, and mining pools remain targets. Even if the Bitcoin network is secure, the ecosystem around it isn't invulnerable. The fear of state-level attacks is weighing heavily on the market. What does all this mean for everyday crypto investors? The latest dip is a wake-up call. Crypto is shaped by a complex mix of market forces, institutional moves, and global politics. The market is maturing, decoupling from traditional signals, and demanding more transparency and risk management. Major players, from Wall Street to world governments, are now deeply involved, bringing both legitimacy and new risks. Success in crypto now requires education, caution, and a long-term view. Focus on fundamentals, real-world adoption, technological progress, and regulatory clarity. The current turmoil is part of the market's natural cycle, testing resilience and weeding out speculation. For those who do their homework and manage risk, the future of crypto still holds promise.